Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we are here to talk about payrolls. The expectation from the Bloomberg survey is that we're going to get a plus 138,000. That would be a bit of a cooler pace from the previous month, but this would potentially translate into an unemployment rate of 4.2%, which again, in the expectation of the street, would be steady. Here to take in the data with me, Catherine Ann Edwards, labor economist and independent policy consultant. How you doing, Catherine?
Good morning. I'm doing well.
Glad to have you. Also here, Jose Torres. He's a senior economist at Interactive Brokers. How are you, Jose?
I was doing all right, but now that we're starting this live stream, I'm doing great. Thanks for having me, Jonathan.
Love to hear it. Love to hear it. All right, Catherine Ann, do me a favor and set us up. Where are we in this labor market? Just to editorialize a little bit, people talk about how this is sort of the first post-reciprocal tariffs data point, but really the reference week for this stat is early in the month, so I don't know how much to make of it. What is the context that you would provide here, Catherine?
If we saw layoffs, or if we saw big changes in the numbers from expectations that we would accredit to tariffs, that would be a remarkably fast effect in the labor market for an announcement of broad tariffs. We know the mechanisms for tariffs affecting the labor market through disruptions to supply chains, increase in prices, but simply, the reference week is the second week of the month. So just an announcement affecting jobs would be very surprising. And we should expect this report to be holding steady.
Okay. Jose, same question to you. What should we make of this? How should we read this number?
I think coming into April, employers were presented with an elevated amount of uncertainty because when President Trump came out in the Rose Garden, the White House, with that board and all those elevated numbers in terms of reciprocal actions, folks got scared. Market participants were scared. Employers were scared. And it's a natural tendency to want to pare back. Earlier this week, Tuesday, Wednesday, and Thursday, JOLTS, ADP, unemployment claims, all weaker than expected. I think today's number is also going to be a little weaker. Not representative of labor market deterioration, in my opinion, more a softening, a wait and see kind of posture on behalf of corporates.
Yeah, and Jonathan, in the April Beige Book, which of course we just got, there was mention of layoffs, but most of it was about federal government layoffs or nonprofits and contractors that were affected by federal government layoffs and funding changes. Most of the idea of reduced headcount was that firms were planning on reduced headcount, but they hadn't taken action yet.
Okay. And Jose, if we're going to start seeing layoffs or softening in the labor market, where do you think it might appear first?
Well, I think the more cyclical areas, it'll appear there first. I think retail, manufacturing, construction. But that's not my outlook. I would expect the cyclical areas as well as of the federal government. But I really think that job growth is going to begin to accelerate in a few months following this print. So I'm not really worried about a tick up in unemployment that's too significant.
Yeah, one of the interesting things is one of the sectors that has really sort of carried the gains in non-farm payrolls over recent years, I would say, is the healthcare space, healthcare and education, you might say, and those are areas that you would not expect to be particularly impacted here. So maybe a sense of a buffer to the top line number you would like to hope, but it's all going to depend. Also, going to be super interesting to watch the market reaction here. This is the middle of earnings season, of course, and earnings season has been relatively decent. If a source of uncertainty, a number of firms have pulled their guidance in a reflection of how sort of uncertain this environment is. But all told, earnings have been beating expectations, and so on and so forth. We'll bring you this number when it drops in just a moment here. So there you go. We have that populating on your screen. As you can see, the change in non-farm payrolls is a plus 177,000. That is slightly better than the survey, which was expecting a plus 138,000. And we get an upward revision to prior. Actually, let me amend that. The 2-month payroll net revision is a negative 58,000. Your unemployment rate ends up staying steady at 4.2%. So a little bit of a nothing to see there. Labor force participation rate, interestingly, ticking up a little bit. Your underemployment rate ticking down a little bit. And just finally, on average hourly earnings, you see the month-on-month slowing a little bit. Your pace of average hourly earnings, it's a plus 0.2% for the month of April. On a year-on-year basis, that translates into a plus 3.8%. And average weekly hours, this is also kind of interesting. Average weekly hours can be an early sign of some softening. Average weekly hours actually bumping up just to 34.3 from 34.2. So high level, Catherine Ann Edwards, what should we make of these numbers? Doesn't seem too bad, right?
I mean, other than a kind of big revision from last month, I mean, this is a pretty muted report. I wasn't going to say boring, but I'm not seeing, any big jump in numbers, which is good. I mean, the labor market wants stability and predictability, as do most employers. So it's good to see a good print. I think hopefully this will quell some of the uncertainty qualms that employers are having. I don't know if that will motivate them to hire. Can't change, a good labor market report can't change the number of orders they have or what their business looks like, but hopefully it can calm some nerves.
Yeah. Jose Torres, so we're now looking at a 3-month average change of plus 155,000. Nice to look at the 3-month average to smooth things out a lot. We were talking about at the outset, we got a bit of a shock in early April. Looking at the numbers here, plus 155,000 for the previous 3 months. Was this a vulnerable economy that we carried into the early April shock, or is it actually on decent footing, do you think?
I think overall it's on decent footing. January made a lot of us nervous. Consumer spending volumes from adjusted for inflation in real terms dropped significantly. We didn't get a rebound in consumer spending in February either, but March was terrific. And that's sort of the consumer that we've been seeing post-pandemic, managing the pressures of elevated interest rates as well as high prices with sort of light switch spending. Some months coming out really strong, and then other periods paring back, recovering, replenishing those funds a little bit. Another interesting point, we saw roughly a decade low in the average work week of 34.1 back in January as well. And as you mentioned earlier, that does serve as a leading indicator of labor market weakness, because generally speaking, when businesses want to reduce labor costs, they start off with trimming hours before trimming workers. But that jumping back up to 34.3, back up to the November level, that's pretty encouraging. Also, sectoral breadth, really strong, sporting a non-cyclical tilt. You also alluded to this earlier. Education and health services taking the lead at 70,000. Transportation and warehousing adding 29,000, second in line. Leisure and hospitality at 24, and broad participation across.
Okay, so I put up the yield on the 2-year Treasury note here, so folks can just see the action. Off the back of this number, you do see a little bit of a bump up. Let's call it 4 basis points in the 2-year Treasury note. Jose, let me go back to you first. What do you think this means for the Fed? We've got a Fed meeting coming up next week. and of course, there are still some expectations that there are going to be some Fed cuts in the pipeline later this year. Do you think this changes anything?
I think, not necessarily. I think we're going to get that first rate reduction in June. For us to get
In
a
June,
rate,
not this meeting, but the following.
yeah, not the meeting on the 7th next week, the one in June. That's where our prediction market here at Interactive Brokers, that's where investors are predicting a cut first in June. For a cut to occur next week, you would have had to have a terrible number this morning, and you didn't get one. You got a pretty strong one. That's why yields are jumping on the news. However, inflation is right at the Fed's target, more or less 2.3% on headline PCE. So I think that despite the concern of a reignition in goods price pressures, we do have a lot of offsets, namely wage pressure is decelerating. We saw that today. And then we also have really low energy prices in most cases for small and medium-sized producers below their break even. So I think inflation is cooperative, and the Fed is probably going to cut 2 or 3 times this year.
Okay, Catherine Ann, how are you thinking about the Fed here? And what do you think? What do you think the Fed, I guess Jay Powell at his press conference, should do with this situation? Like, do you think when we hear from the Fed next week, we'll hear them sort of somewhat explicitly come out and lay the table for some cuts in subsequent meetings?
They like to be predictable, and they like to be, transparent to the extent that they are transparent. I mean, they don't want to shock people. And so I think he will have a pretty measured response that there's nothing too worrying in the labor market yet, aside from, the really low hiring that has been persisting, aside from, that about a third of our job growth comes from a sector that doesn't reflect economic strength or activity necessarily, but an aging population coming from health. I think they'll say that this is more of a wait and see. And I don't know if I think he'll probably put in, maybe telegraph that there'd be 1 or 2, but it all depends on when the effects of tariffs start to show up in economic data, I think is it. I don't think they want to commit to something before they know all the information.
Right. My sort of understanding about all of this, there's been a lot of what feels like pushback against dovish inclinations in the market from Fed speak in recent months. And my sort of interpretation is that where the rubber hits the road is inflation expectations. If the committee were to become convinced that inflation expectations were feeling unanchored due to tariffs themselves, or maybe the discourse about tariffs, then it would become much harder for them to cut into this environment. Of course, at the same time, I don't know what to make of inflation expectations. I mean, we get these surveys. Some of them are higher quality than others, but we all know that measuring consumer inflation expectations is super difficult because you're asking the public to make a forecast about macroeconomics, basically, and it's a forecast that even macroeconomists are not particularly great at making themselves, and so it's tricky. There are also market-based measures of inflation expectations, which suggest that they're better behaved, but I don't know where inflation expectations are. So how will the Fed know, Catherine Ann?
So the thing about consumer surveys is that economists tend to think that they reflect one of 2 things. One being what we would probably say is animal spirits, but maybe in today's parlance we'd say is vibes, of just people reflecting what they are hearing about the economy and what the news is reporting, what they're talking about. It's their overall mood and sentiments. And so consumer sentiment is aptly named in this case. But the other thing that we think it measures is information that has not shown up in data yet. So this would be your boss telling you, if orders don't pick up by June, we're doing layoffs in July.
Mhm.
or your boss saying we've got enough inventory to keep our price at what it is, but like by June we're going to have to go by at least 10% and you need to be wary. And so what consumer sentiment, to the extent that it's just reflecting the mood of the population versus information that hasn't been actualized in the economy, it is both in some ways informative, but in other ways incredibly valuable. So the Fed knows this, and I think what they're worried about is, you read through the Beige Book, you read through consumer sentiment. I think most people are kind of saying what we can see in this report. Nothing bad has happened yet, but if things continue how they are, we will have layoffs and we will have massive price increases. And so the consumer projections of inflation, to the extent that they're valuable, it's what they are hearing in their basically on the job and in their businesses about what they think is going to happen. So you can discount it as mood, but I wouldn't really throw it out, because they could be reporting on, things that we just don't have the privilege of seeing yet.
Sure. Jose, let me put the question about inflation expectations to you sort of this way. So you see cuts coming. What information would change your mind about that?
Well, I don't particularly love following consumer inflation expectations because, like Catherine Ann said, they're just way too dramatic. And we haven't had an inflationary surge in such a long time pre-COVID, call it the 80s, so a little bit in the 90s at 3 or 4%. So this new inflationary environment has really weighed on moods and sentiment. And totally, when you look at market-based inflation expectations and then household projections, they're totally disconnected. Right. So I do like the market-based inflation expectations more. I think if
people putting their money where their mouth is to an extent, right?
Yeah, and folks that are trained at measuring inflation and looking at Treasury inflation, protected securities, and all that kind of stuff, trading bonds, bills, all that. Now, in terms of what I need to see for the path down the monetary policy stairs to narrow or to close, we would really need to see a significant reignition in goods price pressures that broadens out and overwhelms the cooling that we've been seeing in services as well as our energy prices. That's sort of how I'm looking at things. Services, goods, and energy, for the most part. Goods is a small aspect of the overall economy. In fact, it's been declining throughout the decades. So we could absorb an increase in goods costs and still be near the Fed's target, and they can still sneak 1 or 2 in. Final point here, I'm hoping that the trade conflict is more centered on 1 or 2 nations rather than the whole world, and it looks like that's where we're going. The market is looking like it's going to go up for 9 days in a row. The administration has shown some empathy to market volatility and economic weakening. So, I think that similar to Trump 1.0 from 2017 to 2021, I think the focus is going to be on China, and we're going to have these trade agreements and put a lot of this stuff behind us. Back then, we didn't see inflation move to 3%.
Okay, I'm going to push back a little on calling the consumers dramatic, given that y'all work in an industry that saw a roller coaster of stock market over the past 3 weeks that truly terrified people whose almost entire livelihood is held in asset funds and index funds, and who are terrified about what was going to happen to their long-term investments. I don't know if it's just dramatic to go through what we have been going through in our economy, affecting people's mood. And remember, the largest part of the U.S. economy is the consumption of households. If people are scared, they're going to pull back on spending. That absolutely changes the economy. That's not a perceived effect or an emotional effect. That is a tangible effect. If people spend less, our economy could go down in size because it draws down on consumer spending. And then but that could go the other way. If they're worried about inflation, they could be panic buying now, stocking up on goods the way that we saw that businesses did in Q1, pushing up consumption before future fall. So it's not just dramatic mood. Like there are tangible parts of our economy that are directly affected by how consumers feel. And that, I know that the stock market has been bouncing back over the past couple of weeks, but those first couple of weeks were very scary to savers. And I think that that doesn't go away when the stock market bounces back up. It reminds them just how vulnerable they are to market forces completely out of their control. So they're going to try and control what they can, spending in their own daily lives.
Yeah. Can I try to find some middle ground, and I'll probably misstate it, and then you can both gang up on me. So
Absolutely.
my sense of things is that there's a lot of volatility out there. There's a lot of reason for economic concerns, and households are absolutely not wrong, nor do they need to be lectured to for feeling the way that they feel about their particular outlook. But that is separate from the question of, is a consumer sentiment survey a useful predictor of what the macroeconomic data is going to be telling me 6 months from now, which is the question that markets people are often asking themselves. And I don't know. I also don't know that the sentiment data is not going to be useful. I just know that markets people are juggling with the fact that in 2022, 2023, sentiment data seem to lead us astray in many respects. All right, now.
Yeah.
If I may.
How am I wrong?
Yeah.
How am I wrong?
No. I was going to say that 2022, 2023, 2024, we saw confidence in sentiment numbers. If you plot long-term graphs, well below long-term averages, pointing to a consumer that was just exhausted. And we all remember the research of savings being depleted and all that. And we have been running with a lower than average personal savings rate. Part of that, of course, is high prices, but also demographics, and less of an incentive to maybe save for the long run for demographic factors. But, I think that how households feel are important, but I think that my comments on the dramaticness was more centered on price pressure specifically and how disconnected they were from market-based measures. I think the reason there is the sticker shock, right? You go to the store, to the market, or anywhere, and you're just so shocked that a dozen eggs that used to cost maybe $4 or $5 were now costing $8 or $9. And you go to an automobile dealership and prices are a lot higher. Mix that with high interest rates, servicing that debt becomes overwhelming. And I think those are some of the factors that led to that and continue to drive that disconnect between market-based forces and household surveys.
Yeah, great conversation. I did want to quickly take people through the decomposition. I put it up on our screen here so everybody could see. And what I've put up here is the breakdown of contributions to non-farm payrolls. This is the 3-month moving average. I wanted to smooth it out a little bit and just see, why does it seem like employers are adding jobs at the moment here? And so what you see in the breakdown is that construction has been adding jobs. That's construction of buildings, heavy and civil engineering, specialty trade contractors. It's not really residential so much, so that the base is already fairly low if you're worried about a slowdown in housing activity. Manufacturing, sort of nothing much doing. You do, as Jose and Catherine were discussing earlier in the call, you're getting a meaningful contribution from trade, transportation, and utilities, right? So if this trade episode were not to improve. In other words, some sort of detente with China and an easing of the other tariff agendas, this is where you might see things start to deteriorate. You see a small step down in the 3-month moving average in trade, transportation, and utilities, but this is still a meaningful contribution. Financial activity is chugging along. Professional and business services, which famously includes some of those white collar jobs, so-called white collar jobs, but is obviously a lot more than that as well. It's a bit of a misnomer to just call it a white collar category. Education and health services, though, this is one of these acyclical, non-cyclical, I guess, categories that has really been powering the labor market for quite some time. Anything jump out at you guys from this decomposition that you wanted to call out? I know, Jose, you were quicker to some of these statistics than I was, but is there anything we missed here?
I think leisure and hospitality, that was a leader for a while post-COVID. And that just tells to what Catherine was talking about earlier, the consumer has been slowing down those discretionary purchases. There's no denying that. The eating out to travel, hearing that on the earnings calls from the airlines and the restaurants. And that's I'd like to see that start to pick up in the next few months.
Yeah.
I would say for trade, transportation, utilities, it is falling off from January and February to March and April, but I'm trying to square that with what we just learned from the GDP reports about the surge in imports and the what could be preemptory buying before tariffs went into effect. I was just looking at that number trying to think of what I thought it should say, and I didn't have a good answer. I don't know if I thought it would be higher or lower given what we learned about GDP in Q1. Can you expand trade, transportation, and utilities?
I sure can. Yeah. Let's actually dig into so it's the yellow bar here. Let's do it this way. Okay, so the green is which is the biggest chunk, I guess, sort of lime, is transportation and warehousing. That ends up being a plus 17K, a 3-month moving average. And then retail trade, you see stepping down meaningfully, right?
I was to say, I don't like that retail trade number.
Yeah.
It lost jobs this month, by the way. Last month, rather.
Yeah. So that you think that's sort of a leading category, Catherine? Is that where you're?
I mean, that's just people going out and shopping, and I think they're leisure and hospitality for me, because it includes food, is always a little bit of a goofy category of going out and eating versus, going out to a concert. And retail trade to me is a little bit more, this is you just buying stuff. So yeah, not great that it dropped off as much as it did. But again, this is a reflection of employment and not necessarily economic activity. But if that number stays low or goes negative, that would be starting to reflect some early predictions of perhaps a further drop in consumer spending. But I mean, mostly when you look at this report, we are looking at some pretty small details. I wish that 5 were a 15. That's very different from the jobs numbers went down or unemployment ticked up more than 3 points. We're looking for details in what is ultimately a pretty muted report that doesn't have a ton to give us, which is good. I would have been much more worried about the economy if just 2 weeks of big tariff announcements and the lingering Canada and Mexico tariffs would have had a massive effect on the labor market. That would have, to me, portrayed a much weaker labor market than we have, and we should be strong. And I'm glad we are, because that gives us more room to withstand whatever is coming.
Yeah. All right. Well, listen, I wanted to close just thinking about where we've been here, because if you look at the S&P 500 chart over the past 30 days, it is absolutely bananas, right? So we had a really big sell-off sort of shortly after the so-called Liberation Day reciprocal tariffs announcement. And then little by little, we clawed our way back. So I want to put to you both, what have we learned from the past month in markets? And I'll go first. I will say that markets are really, really committed to this idea that Donald Trump doesn't really mean what he has been saying for a long time about trade. They really, really, really think that there's going to be a meaningful walk back in these tariff policies. Jose, what do you think?
I think the market and earnings expectations weren't realistic when considering total trade confrontation, which is what Liberation Day was all about. But now that we're beginning the month of May, the conversation has shifted. We're talking about trade agreements almost nearing closing relative to South Korea, Japan, India. Things with the EU seem like they're progressing. And to the extent that we have good trade deals with 80% of our trade partners, the path for earnings all of a sudden opens up significantly. And that's why it looks like today we're going to have 9 days in the green for the S&P 500 in a row. Final points here: investors have a lot to look forward to. The business investment numbers in Wednesday's first quarter GDP report were terrific. I think the surge in imports is going to serve as a tailwind, the technical tailwind in the second quarter. Then you also have a GOP taxation package that's likely on the way, low energy prices, milder regulations. I think the path towards earnings growth has opened up, and that's why the market is likely going to finish up for the 9th day in a row today.
Catherine Ann?
I keep thinking of what we learned on Liberation Day that wasn't about tariffs. I mean, we announced these broad tariffs from the Rose Garden, and within hours, right, we had picked apart that chart for just how ridiculous the underlying notions behind it were, and where these trumped up formulas came from, and how little thought there was behind it. I mean, the idea that he's a deliberate and hard-hitting negotiator that's going to do right by the American worker was in some ways like an emperor has no clothes moment of like, wow, they just made up formulas, and they put trade, they put some of the highest tariffs on people who don't even have a trade barrier against us, right? I think the lack of deliberateness around that announcement and how slapdash it was and how hollow some of the reasoning behind it was something that a lot of people will never unlearn. Right, we negotiate trade deals, great. I think some people's confidence comes from thinking that Trump has less control than more, and that he's being reined in as opposed to ruling freely. And I think he comes with uncertainty and a lack of depth when it comes to economic leadership. And a lot of people learned that, consumers learned that, businesses learned that. So I'm glad that the market recovered, but I think, Jonathan, to your point, it's recovering from assuming that he's having less control in this moment as opposed to more, which means that a lot of our economic certainty comes down to how much the president talks or has control in the economy. I mean, that's just not a good place to be in. So I think about that like big chart and how quickly, I mean, it was just like fire of how ridiculous it was for so many people. And that's hard to forget about. That's hard to think like, yep, and we're back into a place of great economic stewardship until he changes his mind again.
All right. Well, let's end right there. Thank you very much. Thank you to Jose Torres. Thank you very much, Catherine Ann Edwards. My name is Jonathan Levin with Bloomberg Opinion. Your unemployment rate in the United States of America is 4.2%. Please join us for Fed Day next week. Take care.